Deeper insight into the markets, Manishi Raychaudhuri, Asia Pacific Equity Strategist at BNP Paribas. He's joining us right now on the show. Manishi, thanks very much for taking out the time. And the last time we spoke, you spoke about how the investment engine was warming up, how from a foreign investor point of view, markets like Indonesia and India are still more lucrative compared to some of the other North Asian markets. Is that view of yours still applicable?
All right. I would think pretty much, because if one looks at the earnings estimates, North Asia has suffered a lot more than South Asia and India. I think consensus EPS in South Asia and India are down about 5 to 7%, possibly at most about 10% over past 6 to 9 months, while key North Asian markets have suffered to the tune of 20 to 30%, and I'm talking about Korea, Taiwan, and other parts of Greater China here. So I think, on a relative basis, I think the investors' interest in India and South Asia continues. Having said that, there are some country-specific factors that we have noticed, particularly in India after the budget, which has led to some degree of concerns as far as the foreign portfolio investors are concerned, and that's led to some of the outflows that we have seen of late. But I would think that over the longer term, the basic positive feeling, the bullishness about Indian equities still continues among the foreign investor base.
Okay. The other point, obviously, now is post-budget. Now that you are seeing foreign investor limits being up, the expectation is that free float of some of the Indian companies will increase. Their weightage in benchmark indices globally will increase, and therefore more interest from foreign institutional investors will be seen in Indian stocks. Is that something you concur with?
Right. Potentially, yes, even though we don't know the details. So, for example, all we know is that the government has instructed SEBI to consider this step. We don't know the details as to how long or what time frame the SEBI would ask the companies to comply with it by. We have the example of 2010, when there was a 3-year time frame given to the companies. But broadly, a larger free float obviously qualifies as a reason or a driver for larger weight in the indices, and I think that is more important at the present stage when we have the weight of China increasing gradually in the benchmark indices as a consequence of MSCI including the A shares and increasing the free float inclusion factors for those stocks. So I think it is important. It would potentially lead to larger degree of interest among the foreign portfolio investors. It has to be done judiciously, though. Some leeway has to be given to the stocks or companies which are newly getting listed. There has to be a certain time frame permitted so that we don't have oversupply of equity in the market. But if done correctly, yes, definitely it could be a positive driver.
Manishi, good morning. Just wondering, as you look at the Asia Pacific region or the EM region, as the case may be, would you find jurisdictions that are similar to India in terms of growth or maybe marginally lower, but way better in taxation for global investors, and therefore post this budget, would those investors prefer those geographies? Would you, as somebody who looks at Asia Pacific and not just India, be inclined to tell some of your large customers to look at those geographies as opposed to India?
Right. So, as far as the taxation element is concerned, obviously the relatively developed part of Asia, if one looks at Hong Kong or Singapore, for example, they attract much lesser degree of capital gains taxation. So, in Hong Kong, for example, there's no long-term capital gains. Both and majority of the flows inside are from overseas investors. But at the same time, I think investors don't simply look at the taxation angle and the taxation angle only. There are other fundamental factors they would also consider. The only problem is that over the short term, an increased degree of taxation on capital gains does tend to dampen the sentiment. we are also living in a very low yield kind of world. The hunt for yield is kind of alive everywhere. So if one reduces the potential return to investors in a low yield world, then that particular market becomes to that extent relatively more unattractive. And I think that's what we saw in the first few days of July, right after the budget presentation, when India did suffer some outflows. But I think over the longer term, even the foreign portfolio investors would ultimately look at the fundamentals of Indian equities, fundamentals of Indian companies, and for them, the decline in cost of capital, a potential revival of the capex cycle, would turn out to be possibly more important.
Yeah, we're just having this bit of a war on social media with regards to that as well, Manishi, on this whole point. Now, the lower cost of capital, I believe that could be the theme. But the counterpoint to that is that the lower cost of capital, brought on in large part by the slower demand, may not be material for private investment, and therefore we may not be able to time this to the T. The argument is that it will not happen in a hurry, it would happen in the next 6 to 12 months. But who knows? What if it doesn't happen in the next 6 to 12 months, and then you're caught with companies which don't necessarily have the best return ratios, which do not reward by hefty dividends, and are waiting for that ever elusive capex revival to happen?
Yes. No, I agree with you on that. It's difficult to time it to a T, to borrow your phrase. So I think this is turning out to be, number one, a market for long-term investors who would possibly not be too perturbed by the short-term fluctuations. And second, it is also turning out to be a market for, really thoughtful and careful stock and sector selection. That old way of investing lock, stock and barrel into certain sectors which are in vogue, that is unlikely to work. Broader market investment or broader sector investment will have to be, sort of overlaid by very careful stock selection in this market. There are certain kind of themes that we prefer. You alluded to dividend yield. Indian companies, by and large, are not known for that, but that is one theme that we are recommending to investors across Asia. And there are quite a few interesting opportunities that one can find in North Asia and pockets of South Asia as well, like in Singapore, like the real estate companies or the REITs over there. And unfortunately, India doesn't quite fit into that theme. But the other theme that India does fit into is domestic consumption. And that, I think, has been relatively robust and relatively stable in a universe which is turning protectionist increasingly.
Manishi, as I look at the foreign institutional investor data, compare the equity inflow versus the bond inflow, the last 3 months, quarter to date, it has seen a complete reversal. So a lot of more money has been flowing into the bond market as compared to the equity market. Is that a place where most foreign investors are likely to show interest compared to the equity markets, considering how the yields have been falling since I think mid-April is when we were at 7.4, 7.5. From there, now we're at 6.3.
Yes. Yeah, I think, this again sort of, correlates with the discussion on lower cost of capital that we had talked about earlier. I think, the consensus opinion at this point of time is that yields are likely to decline. Partly because globally yields are declining and emerging markets, including Asia, are following suit. We are constantly seeing central banks in this region cutting rates. In fact, India was one of the early movers in that respect. We are now seeing and are likely to see more from Southeast Asia, including Indonesia tomorrow, for example. And we think that this is kind of an affirmation of the fact that global investors believe that yields are likely to decline going forward. Coming to India, I think there's another additional tailwind to that, which is the decline in inflation, which would also be strengthened by an improvement in monsoon precipitation, which we have seen in the first few days of July. And if that indeed turns out to be better than what the market expected earlier, we could see further decline in inflation and possibly maybe not one but even 2 rate cuts by Reserve Bank of India. Yeah, as of now, our expectation one in August rather, and then possibly the RBI is staying pat for a few months before acting again next year. But who knows? I mean, if inflation keeps on shooting well below the RBI's target, there could be a different reaction function from the central bank.
The other angle also obviously would be on the back of these lower cost of funds. Who can capitalize on this the most? And do you expect financial intermediaries now to be the hotspot?
I would say the private sector banks, both retail lenders and corporate lenders. And I've made this point before earlier on this channel that earlier in the year we were focusing only on the private sector retail lenders, but now we think even some of the corporate lenders who have possibly put the bad asset situation behind them, they would qualify as interesting investment targets. One overarching theme here is gradual gain in market share on the part of both private sector banks and non-banking finance companies. The NBFC universe remains a bit risky, and we would like to see some resolution over there before jumping in. But the private sector banks, both retail and corporate lenders, fit our bill quite fine.
Manishi, the other argument is exporters now. The yields are falling in India, the currency is strengthening, though one would, the views differ on what the currency could do. In light of all of this, do you believe the exporters could give you a good bang for the buck? The commentary from Infosys wasn't the worst. Pharma companies, the valuations are in your favor, but I don't know how you view the business environment for both.
Right. At this point of time, we prefer the domestic plays compared to the exporters. As I said, that we're living in a world which is increasingly becoming protectionist. That's a clear sentiment dampener for the Indian exporters as well, even though their business haven't been directly impacted as a consequence. And as you rightly point out, that with the Fed likely to commence a reduction in rates from July, we could actually see the US dollar depreciating. In fact, our point of view is that the dollar would depreciate primarily against the developed market currencies, but also partly against the emerging market currencies. So in that environment, some of the strong tailwinds in favor of the exporters would be history. So at this point of time, we clearly prefer the domestic plays in pretty much all the markets that we track, and specifically in India as well.